In the wake of the recent surge in bond yields, the stock market finds itself navigating through choppy waters, facing a stark departure from the relative stability observed earlier in 2024. With Treasury yields hitting their highest point of the year, equities experienced a pronounced downturn, hinting at a potential shift in investor sentiment. This sudden turn of events has been fueled by a flurry of economic data releases, providing ammunition for those who anticipate an extended period of elevated rates. While last week's PCE data hinted at a modest slowdown in inflation, Monday's manufacturing figures presented a contrasting narrative, showcasing an expansion in both activity and prices. Additionally, the resilience displayed by the job market, as indicated by Tuesday's JOLTS report, added further complexity to the market landscape. However, rather than fundamentally altering the overarching narrative, this data has served to reinforce the prevailing expectation that any potential rate cuts may be deferred from their initially projected timeline. Despite the prevailing uncertainty, equities have showcased a surprising degree of resilience, with the S&P 500 notching an impressive 22 new closing records this year, propelled by gains of approximately 9% despite the recent market turbulence. So, what triggered the pronounced shift witnessed on Tuesday? A closer examination reveals that the underlying fundamentals have seen little significant alteration. Despite a brief spike, the VIX index, a crucial gauge of market volatility, remained relatively subdued, hovering around the 15 mark, still considerably lower compared to historical benchmarks. Similarly, while the 10-year yield experienced a palpable uptick, it has yet to surpass its peak level observed late November. Notably, the S&P 500 managed to skirt past the 1% decline threshold, underscoring the market's resilience in the face of heightened uncertainty. Liz and Sonders, chief investment strategist at Charles Schwab, emphasized the critical importance of deciphering the rationale behind the Federal Reserve's actions, highlighting that understanding the why behind their decisions is paramount in navigating the intricacies of the market landscape. Krishna Guha, vice chair at Evercore ISI, underscored the significance of indicators of tightness within the economy over broader indicators of strength when assessing the rates outlook. He pointed out that while robust economic activity and resilient payrolls may not inherently pose a direct threat to the inflation outlook, signs of tightening remain pivotal in shaping market sentiment. Looking ahead, all eyes are on the forthcoming March jobs report scheduled for Friday, which stands as a potential linchpin for further market volatility. However, if the data indicates stronger than anticipated economic performance, any ensuing market sell-off may prove to be short-lived and potentially unjustified, according to insights gleaned from market analysts and strategists.